Welcome, everybody. My name is Greg Leparati. I'm Associate Director of Alumni Relations here at Baruch. It's a pleasure to have you all with us this evening. This is the first financial literacy event of the calendar year, I think, right, Alan? So
Yeah, definitely.
looking forward to this. Yeah, we've been working with Alan Chen on financial literacy events for the past few years. They've been super informative and helpful for our alumni, and we're so pleased to have him back for another year. I hope everyone else is having a good start to their 2022. A few quick ground rules. You can leave your cameras on. We love to see our smiling faces of our alumni, but please do mute your microphone so we don't have any noise distractions during the presentation. We will distribute a recording of this event afterwards, so don't worry about that. And please direct questions throughout this presentation to the chat bar. Alan is very good at addressing those questions during his presentation, but if there's anything we don't get to, don't worry, because we will have some dedicated time at the end to field some remaining questions. So no need to worry if we miss anything during the presentation. I would like to introduce our speaker now, Alan Chen. He graduated from Baruch in 2017. And he realized shortly after he got his first job that he actually didn't know how to manage his own personal finances, despite getting a degree from a great business school like Baruch. He kind of realized that this is something that people don't necessarily think about when they're younger, when they're in school. And so he became something of an armchair expert at financial literacy. He comes from a low-income family and has seen firsthand the pitfalls of poor money management, not saving early enough for retirement, which is precisely what we're going to talk about today. Now he wants to share his knowledge with the Baruch community. His goal is to help people retire happily. By day, he's a software engineer at Rent the Runway, and by night, he studies financial literacy and has also launched his own YouTube channel. So we're delighted to have Alan Chen with us here this evening, and I will now give the floor to Alan. Alan?
Thank you, Greg. Great introduction. I don't even need to talk about myself anymore. Awesome. Thank you everyone for coming. I appreciate it. I know it's a tough day after work, and now I'm about to hit you all with retirement, the most exciting topic in the world, right? But I do appreciate everyone for coming. When I first, got my first job and I started thinking about retirement, it wasn't top of mind, right? It was something that I put aside and really started thinking about after my first year of work. And that's where I started doing a lot of research and realizing I don't know a lot about investing or about retirement. And that's when I started digging into really deep into how can I maximize my returns for retirement, because you only get one shot at retirement, right? You better hope you get it right 40 years down the line, or however many years you have left until retirement. But the goal here is to get everyone up to a certain standard of understanding what we need to know when it comes to picking retirement funds. There's going to be many paths forward, but we'll get a good idea about where we can go from here. All right, so I know Greg already gave an introduction, but I had this slide anyway, just to give a quick, small introduction on top of that. So as Greg mentioned, I do come from a low-income family. So my parents never knew what a 401k is, 403b, all of these things completely unknown to them. They just said, hey, better save your money in a bank account and hope for the best, right? So that was tough, right? That was something I had to learn by myself and really talk to my friends about it if they had accounts of that sort. Graduated from Baruch in 2017. Also, here's one fact about my 401k, just to give a fun fact about the topic. I did increase my 401k by 59.9% after contributions over 4 years. Right, so this doesn't include my contributions. So I've grown my money a substantial amount, but one might say, hey, the stock market's been growing for the past decade or so, so it's hard to lose money, but better to grow your money than to lose it. Now, the fun fact is in 2021, I bought my first home, which was worth around $4,000, which is a condo. I did a workshop on that in the past last year. So if you have questions about that, hold off until the end and I could talk about my home purchase journey. It's definitely an interesting one. Anyone from outside of New York City? Yes, I am from New Jersey. I actually moved to New Jersey to buy my condo. So shout out to all the New Jersey folks. All right. Disclaimer. I am not a financial advisor. Like Greg said, I am a software engineer by day. So any information you hear on this workshop is strictly for informational purposes. I'm just sharing what I know and what I did, not recommending or telling you what to invest in. That's something you need to do on your own time and invest, or find a financial advisor to invest with you on that. All right, retirement funds. Oh, one other thing. Like Greg mentioned, make sure to ask questions in the chat if you have them. We're happy to get to them as I go along, or you can wait till the end. So retirement funds, a little tricky for those of you who are aware of retirement funds. We can think of retirement sort of like an idea of saving for the future. And to do so, you need to invest your money. You can't just let it sit in a savings account. You can, but it's going to make it so much more difficult to save up that amount of money, right? So the best way to go about it is just to really invest in your 401k. Right? For most of us, if you put your money into a 401k, they're going to invest it in some form or format, and you can select a wide variety of options. Right? Most of them tend to come in the form of a mutual fund. If you don't know what a mutual fund is, think of it like an asset where you can pool a bunch of money from multiple investors to buy a large number of financial assets. Right? This can be anything from stocks, bonds, etc. Right? The idea being is that you reduce risk by doing so. Is anyone not mute on the call? Just to make sure you don't get caught in the recording, make sure to mute yourselves. I do hear some music playing in the background.
I just made sure to mute everyone. No worries, Alan.
Great, thank you. Awesome. All right, so in the case that you do select some mutual funds, right, your 401k provider, your HR department told you, hey, pick some funds. Doesn't matter what you do, just pick some funds so you can get started. Better than not investing. I would say that no big deal if you think you made the wrong choice in terms of investment options. Your provider usually will allow you to change your investments, right? This is the idea of rebalancing, and people will tend to need to do it every so often anyway, just to make sure that their asset allocation is correct in line with their risk tolerance. Great. This is an interesting one. How much should we contribute to our 401k? What is that percentage? Experts always say 15%, but in reality, it's more likely it depends on what your financial goals are, right? So if your financial goals, for example, my financial goal is, one of my financial goals is FIRE, right? So financial independence and retire early. So what that usually means is that I personally should max out my 401k. So I should put that out the maximum amount. In this case, this year is $20,500. Right? So depending on what your financial goals are, right? If you think about buying a house, you put money into a 401k, you can't get that out until 59 and a half for the most part. So you shouldn't put all of your money into the 401k if you're thinking about more immediate financial goals. So it's really thinking about exactly how long that time horizon is and how much you need to save to have enough money for retirement. So it's a little tricky, but there are ways to calculate that number. If you're interested, we can talk more about that towards the end. Target date versus picking your own index funds. We'll talk about that in a little bit. We'll talk about that and it will come up. So just give an example of what these 27 options look like. I'm sure if you have a 401k, you see something like this at some point when you are setting up your 401k and your accounts. Personally, when I started, I had 27 investment options. I know it's a lot of options, and for some of us, that may be very confusing, especially if you don't have a finance background and you don't know what all these things mean, like what's a return, what are these ticker symbols, what's all these numbers mean. And that's all right. The idea is that hopefully by the end of this workshop, you'll have a good idea about how to approach these, or at least one path forward. Right? It kind of sucks because if you make the terrible move or you make a wrong move and invest in something that doesn't grow as much, potentially you can't retire. Right? Not to scare you, but that's really what the consequences of not wisely investing in your 401k are. So I just want to say that it's okay to be overwhelmed, right? When I was looking at my investment options, I was a little bit overwhelmed as well because there's so much information. No one is there to guide you unless you have a financial advisor. If you're a beginner, that is an approach to you. Otherwise, it's tough, right? You don't know what's happening. You're just spending a lot of time on Google, hopefully, hoping that you Google the right terms just to understand what's happening with these investment options. what happens if you go over the annual 401k contributions based on percent of a regular salary? That's actually really interesting. So if you go over, you're gonna have to withdraw the money for the most part. But if you don't know what's happening or how that plays out, definitely talk to a tax advisor. Personally, yes, personally, most companies would auto stop contributions, so you don't have to think about it. So let's say you say, hey, I'm gonna put in like $10,000 every month. It's gonna hit the max in 3 months because the maximum is $20,500. So it would just stop, and your paycheck wouldn't deduct the amount into your 401k anymore. So if your company does that, they should be doing that. There's a chance that they don't, so make sure. This is why it's so important to look at your paycheck every time you get one, to make sure that, hey, are they putting enough money into my 401k? Are they putting too much? Are they putting too little? Because over contributing, under contributing, these things do happen. Yeah. Also, there are some financial advisors on this chat. So if you're there and you would like to contribute and help out with these questions as they go along, please do. Just because there's going to be a lot of questions. But yeah, it's definitely the plan usually does not allow you to contribute more than 20,500 or whatever the maximum amount will be that year. It does get adjusted every year potentially, right? Sometimes it stays the same, but generally speaking, it does adjust upwards due to inflation. All right, so there are several approaches to picking retirement funds, right? Going from the least amount of effort to the most amount of effort, left to right. So the most simple one is finding an advisor, right? This is going to be the financial advisor. This is the person that's pretty much handling everything for you. And it's going to be the most expensive option out of all of these, right? And rightfully so, because they're doing most of the work for you. You don't have to think about retirement. You just got to tell them, hey, what would you like to do with retirement? What would you like to aim for? Do you want to live? You want to spend more money in retirement, less money in retirement? Basically, you tell them exactly what you want, and they'll work out an investment plan for you, right? That's the whole point why you would pay them. The second option is age-based funds. Someone else mentioned this in the chat as well. Another name for them is target date funds. These are funds which we'll dive into more detail. Basically do some of the investing for you based on the age you are, right? So for example, if you're retiring in 2060, it just means you're further away from retirement, so your investments tend to be riskier. And there's there's a fund manager or a team of people managing your money for you, so that when you are closer to retirement, your investments are more safe. And when you are further away from retirement, your investments are more risky because you're trying to make more money over a longer period of time, right? And then finally, there's DIY, do it yourself. This just means you are picking your own investments, trying to figure out what's the best approach here. And obviously, this approach where you do most of the work means it will cost the least amount, right? Because you are handling most of the choosing the investments, managing the risk, and just rebalancing every quarter, every month, and so on, right? So there's more involvement here. But I will say that none of these approaches are guaranteed to make you money, right? It's more of how you approach it, right? Any investment approach is going to have a certain amount of risk with it, so there's no guarantee you'll make money from this, just like how any investing goes. Sponsorship/record keeping. Do an annual non-discrimination testing to make sure that 401k meets IRS DOL standards. Huh? I'm actually not aware of that at all. I actually never heard of that at all either. So if someone there's a financial advisor on the chat who can answer that, I'd be very curious about that. But I would say that personally, the way that my company does it is that we hire a firm that selects which investment options we have access to. So the 27, they select it, and they will rigorously basically go through the standards as needed. So they may or may not go through these standards, but if we hire them for it, hopefully they do go through these standards. But generally speaking, at least your 401k funds should be vetted. No guarantee that they are necessarily. I know that mine are to a certain degree. All right, so if you have a financial advisor, I won't spend too much time on this one because the whole point of it is that you don't think too much about it, right? You hire a financial advisor and they handle it for you. Um, I would say that a financial advisor is going to be more expensive depending on which one you hire, how much time you spend with them, and what their fee structure is. But generally speaking, it's going to be the most expensive out of the other two options, just by nature of what they're doing for you, right? They're reducing stress, so that's something that you really value. This is the path to take. They save time, right? If you're doing it yourself or you're doing your own research, it's going to cost you more time, right? To just handle everything and understand what's happening there. But I will say it really depends on your financial advisor, right? Not all financial advisors are created equal. Some are great, some are fantastic, but some aren't great, right? There's no refunds when it comes to an advisor. So just make sure that you vet them, right? You find people who you trust and you know that they value your time and they value what your financial goals are and they can help you approach those topics. Someone mentioned I met a financial planner who was fiduciary. She wasn't selling anything. Great, that's good to hear, right? You want to find someone that doesn't have any vested interest in pushing products onto you. Pay an hourly rate. Yeah, that's awesome. She reviewed 401ks in less than an hour. Yeah, that sounds great to me. But yeah, definitely something to consider. I would say that I've encountered financial advisors who are very pushy, right? They keep trying to sell you insurance products and so on. And sure, there may be some benefit to you, but it just comes off as, you're trying to push things on me that I may or may not need just so you can make some extra money on the side, right? And just, build your wealth versus my wealth. But some financial advisors are great, right? So it's just, figuring out which one works for you. And it looks like someone in the chat had a good experience with one. So that's good to hear. All right, moving on. Age-based fund guide, right? So age-based funds, like we mentioned a little bit before, basically, this is the general recommendation for people who are just getting started out for the most part. Obviously, still do your own research. But generally speaking, this is what I hear a lot. People telling me to invest in an age-based fund if I don't know what I'm doing. And basically, what's happening here is that it tends to be less expensive than a financial advisor and a little bit less complex than a DIY approach because most of the time you're putting 100% of your money into an age-based fund because you're trusting a fund manager to manage your money for you for the purpose of retirement, right? So they'll shift your money around as you get closer to retirement. And then by doing so, they can maximize your gains and reduce the amount of risk you have, right? So reducing the chance of you losing money as you get closer to retirement. Now, 401k provider will usually offer multiple age-based funds because age-based funds were designed for the sole purpose of retirement. So chances are they'll be there. But the first step to selecting an age-based fund is to calculate the expected retirement year, right? So usually people do retire between 60 to 67. You might retire earlier or a little bit later, depending on what your financial picture looks like. But figure out what that age is, and then look for funds with years next to them. Right? It's very easy to spot an age-based fund because it's in the name. Basically, they're going to have years next to them, and you select the fund by rounding to the nearest expected retirement year. Right? What year do you see yourself retiring in? And then that's the fund that you pick, and then they will invest for you with that in mind. The thing is, they don't take into account many aspects of your financial life. They just assume one thing: you're retiring on this year, so we're going to invest with that goal in mind. Right? So that's where this approach does lack when you compare it to a financial advisor or when you compare it to a DIY approach. Right? There's no customization really. It's a general bucket for the year that you plan to retire on. And just a quick example, just to illustrate that. Let's say I'm 30 today and I plan to retire at 67. So that retirement year is 2059. And if you do the math and the formula below, that's what you end up with, 2059. And you just go down the list of funds. In this case, my list of 27 funds, and you see them with a bunch of years. And these are the age-based funds, life cycle funds, whatever you want to call it. These are the funds that are designed based around the year that you retire on. And you'll see that if you're retiring at 2059, I would pick 2060, right? This is the year that's closest to where I am planning to retire. You can round it up or down and you'll end up on that year. and that's the fund that you would invest in based on how far away you're from retirement. So most beginners do take this approach. Obviously, make sure you do your research. Not all age-based funds are created equal, right? Just because you see the year that you retire on doesn't mean you should invest in it. It means you should, dig into it, find more information about it, and just do more research, which we'll talk about in the DIY approach as well. So you can take some learnings from there just to do research on your own. Finally, there's the idea if you want to do something done, if you want something done right, do it yourself, right? There's the idea that, hey, financial advisors cost too much money, or they don't make sense for your current financial situation, or you just want to be more financially educated and you want to tackle it. You have the time to tackle it and the effort and mental capacity when it comes to this, just because it's a lot of information. And the main benefit of a DIY approach is that you can dictate your own investments, right? To a certain degree, you can find the right combination of these 27 investment options or however many you have, and just pick the one that will maximize your return and reduce your risk of losing money, right? Out of all of them, this is the one that gives you the most customization for figuring out what works best for where you want to be financially. The trick here is, since you are doing it yourself, you can also lower your fees, right? You can pick just lower fee investments, but it means you have to take on more of the responsibility for managing and selling and buying those investments as needed throughout the time you have before retirement, or even after retirement. You would have to do it yourself. All right, so a lot of it comes with understanding investment terminology, right? The first thing you can do is find the place, locate the area where you can research the fund, right? For me, I happen to have Fidelity, and Fidelity was a research tool that they had a research tool where you can search up different investment funds. You will probably have a similar investment tool. If you don't, you can just Google it, right? Find what the ticker symbol is or the name of it, and just copy and paste it into Google, and you'll find some more information about what's in that mutual fund, what's in that in those investments, and just get information about it. Investing study done by Russell Investments, having financial advisor adds 4.83% over the DIY approach. Yeah, that's definitely one thing to consider. All right, investment terms. So there's a couple. This is the minimum, I think, in my opinion, to get started. Obviously, if you want more expertise and you want to dig more into it, and you can do that on your own time. The first one here is a rate of return. Right, so rate of return is pretty straightforward in my opinion. We can dive more into it, but it's just how much money you're making, right? Or how much money are you losing? That's really what the term boils down to. Expenses and fees, also straightforward. How much money you're paying out of pocket to basically buy that mutual fund or to be invested in that mutual fund. And lastly, diversification. So diversification is a little tricky, I will say. It's a confusing concept, and in terms of diversification, an age-based fund would do it for you. So think about it. A financial advisor would also handle that for you. In this case, you have to do it yourself, which is tricky, right? Maybe you have some success, maybe you won't, but it's important to understand where you stand when it comes to risk tolerance before you dive into diversification. And we'll have a quick example about that in a little bit. But there's no right answer to diversification. Really, it's more about what you feel the most comfortable with when it comes to investing and how you want to allocate your assets in retirement. So rate of return. So rate of return can be really boiled down to the gain and loss of an investment, right? And usually it's expressed as a percentage. For example, if you invest $100 and you make $7, then your rate of return is 7%. Straightforward, right? Not too complex. If you lose $7, then your rate of return is negative 7%, right? Rate of return is directly correlated with risk, right? Risk is the chance of losing money, right? Just so we can be clear about what it means when we say something that's risky and something that's low risk, right? And what I mean by this is when you have something that's high return, it's generally going to be riskier, right? You're generally going to have a higher chance of losing money. If something's low return, generally speaking, it's going to be low risk, right? You're not going to lose as much money. But if you have something that's high return and low risk, it doesn't exist. That's a unicorn, For the most part, those aren't real. You might find one once in a lifetime, but I think if anyone were to come to you and say, I have a high return, low risk investment, it's probably a scam, right? Unless you do a due diligence and you know for a fact this is definitely the golden goose. I would say for the most part, just be aware of that. Generally speaking, if it sounds too good to be true, it's probably too good to be true. Investing is something that takes time and takes discipline to do. It's not something that can be quickly. It's not quick get rich quick scheme, right? And that's why retirement is such a long investing period. But a good rule of thumb is if you are on the younger side, it just means you can afford a higher rate of return and a higher rate of risk, because if you happen to lose a good chunk of money, or if you lose all of your money, you still have many more years to build that wealth up before you get closer to retirement. All right, so like I showed you before about researching, this is one example of what that research would yield if you find that portal. And this is sort of an example of what would happen if you invested $10,000 into this specific investment or mutual fund. I'm not saying to invest in this mutual fund. You might not even have this as a choice in your 401k, but this is an example of what we can look at when it comes to just seeing how your money can grow over time. So a few things to note, right? It's very fancy chart, trends upward, generally speaking. So that's good, right? You're making money over the past 10 years. It's also up to date. As we know, 2022 has not been very friendly to your investments. So if you've been investing in 2022 or you're staring at your 401k accounts, stop doing it, because it's going down now. So just keep in mind that we invest for the long term, and over the long term, generally speaking, your investments should go up. When it comes to investing, you should not have a short-term outlook, especially when it comes to retirement. Now, this is the same chart expressed in percentages, and you can just see it, more. It's easier to read versus just having a chart with everything pushed into one spot. But you'll see that some years are up, some years are down. That's pretty normal, right? You can't expect to make money every year. What you should expect to see when it comes to a good return is that you are up more years and higher than you are down, right? So you're making more money over the years that you're making money, and you're losing less money on the years that you are losing money, right? So that's very important to keep in mind. You're not going to be green for all years. You're not going to be making money all your years, but you should definitely still be making money over the long period of time. And this will also do a great job at comparing, hey, how does this specific fund compare to other investments out there? Just so you can see, are they doing better? Are they doing worse? Are they doing okay? Just to give you an idea about, did I pick a good investment before you actually invest in it? I mean, one last thing here is historical returns are no guarantee of future returns, right? Just because you're seeing numbers in the past that look good doesn't mean that they're going to look good in the future. And this is true for all investments. There's no guarantee what the future looks like, but all we can look at is historical returns. So that's our best bet for a prediction or a feeling of any sort. All right, so expenses and fees. Right, so fund managers decide what goes inside of a mutual fund. Right, a mutual fund is a collection of assets, and someone has to pick those assets. Right, a group of people will have to pick those assets, and they will have to manage a bunch of documents related to just telling you what's happening with the mutual funds and anything related to investing. Right, so that can get complicated, and they need to be paid for their services. So they do get paid in the form of expense ratios, and this is usually a yearly fee paid to maintain the fund. Right, so usually it's a percentage of your assets, whatever that percentage may be. For the most part, 401ks, many of them do have low expense ratios. Some of them do have high ones, depending on what you're looking at. A quick example is if you have $1,000 invested in a mutual fund that has an expense ratio of 0.05%, it just means you have a yearly fee of 50 cents. Not a big deal, but just be aware that there are fees associated with it. And you will find that these fees are incorporated into the fund itself. So there's not explicitly listed anywhere that they're taking out this money from your investments. And if you're confused at any point, hey, I'm seeing fees. I don't know where they're coming from. That's fine, right? You just have to, talk to your 401k provider, right? Give them a call, give them an email. I've done it in the past. They're friendly. It works out fine. They tell you how they're charging those fees and what's happening on their side. But generally, make sure that your fees are appropriately charged and not overcharging you, because these things can happen. Now, if you're managing your own 401k, how often do you recommend someone should go into their account and rebalance assets allocation if someone has 20 plus years until they retire? What a great question. And I have a whole section on diversification. Just hang on tight, and I'll get there in a little bit. But I would say just a little sneak peek, really up to the person, right? And also depending what you invested in, right? Some people do it monthly, some people do it quarterly, and so on, right? But we'll talk more about that in a little bit. When you look at the mutual fund table from 2012 to 2021, which you showed, how do you compare success to the other two funds at the bottom? What are your benchmarks? It's a great question. When you look at these two funds, my benchmark usually is, are the returns, the years that they're up, similar to the benchmark it's comparing to? I can't expect, it would be nice if they, if these funds beat the benchmark down here, right? If they do it, they beat it like, dramatically. But that's not something that I can expect most of the time, right? So if it's here at 7.71%, then 7%, not bad, right? But it also means sometimes you may lose more money than you can expect, right? So most of the time they show these charts not to tell you how bad their investment is, because why would they ever show you a chart to show you how bad their investment is? Most of the time it's more to show you, hey, we're very closely matching another performance of another index or another measurement of performance, and either we're beating it slightly or we are matching it, right? They're not going to say, hey, we're doing so poorly, it's terrible, don't invest in us. But it's one way to look at it. So that's the benchmark I use. You can obviously go to something like Yahoo Finance, take your investment and compare it to other benchmarks, right? My favorite one to compare it to is the S&P 500. And usually it's easy to compare, right? If you look at the chart and your investment is not doing as well as the other line is higher than your line, maybe you should invest in the one that is growing faster or is growing better, right? That's one way to look at it. But also that's a very gullible way of looking at it, because if your focus is long term, right? If you're thinking about growing wealth, a lot of wealth right away, as you get closer to retirement. But if you are close to retirement, let's say, for example, if you're 5 years out from retirement, then that's something that you need to reconsider, right? Maybe at this point, you don't need to generate a lot of wealth. Maybe you just need to retain as much wealth as possible, right? In the case that recession might occur. In that case, you don't want lines that, go up a lot and go down a lot during recession. You want lines that are relatively flat, right? Lines that don't change a lot, especially in a recession. So, it really depends on what your investment goals are, which is why it also gets complicated when you talk about the DIY approach. But that's one approach to it. But I can walk through an actual example of comparing funds that I'm interested in. If you're curious about it, we can do that towards the end. Keeping out the fees is key. What a great term. Keep out those fees. They eat up your investments. But luckily, they're usually very transparent about those fees for the most part. So they'll have a section called expenses and fees. And you can see basically, hey, they're charging me 0.035% for expense ratio. For context, generally speaking, most mutual funds should charge less than 1%. If anything's charging you 1%, you're definitely losing a lot of money. So if you're seeing anything, hey, 1%, maybe get out of that if you have an option or the choice, not the place you want to be. But otherwise, things that are around, less than, I'm not going to give a ballpark number, but personally, I invest in expense ratios that are around 0.04%, 0.03%, just because it makes sense for me. But that really depends on what your investment goals are. But for retirement, lower fees, better it is, right? You can't argue lower fees unless the fund is not doing so well. Then that's a different conversation altogether. All right, so one thing to keep in mind is you've done all that research, you've done everything, you looked at those fancy charts, but the one thing you should not ignore is the prospectus, right? So the prospectus is this, I don't want to say giant, but it's like, this 10, 20 page PDF where they basically tell you exactly what to expect in the mutual fund, right? What is it invested in? What is the goal of that mutual fund? What are their fees? How are they charging those fees, right? This is a more detailed idea about what they're investing in, and it will be updated ever so often. So things do change. They do tell you most of the time, but definitely look at the prospectus before you start investing because it'll give you a general idea about the goals and where the fund is headed. Someone shared a great doc on what is a good expense ratio. Yeah, check that out. Happy to see people sharing resources. Keep those resources coming because it definitely does help people. All right, diversification. Someone asked questions about diversification. It's not a fun topic. But the idea, for those of you who aren't aware, is generally speaking, diversification is don't put all of your eggs in one basket. Right? So this is the idea of, hey, put your money in multiple assets. Luckily for us, mutual funds by definition sort of do that for us because they pool a bunch of money to buy multiple assets. But one way I want to summarize diversification is it's a continuous and biased risk management strategy requiring a deeper understanding of different asset classes and risk factors, right? So a lot to unpack there, but for the purposes of retirement, the biggest risk factor is going to be your age, right? For example, if you are far away from retirement and if multiple recessions happen, not a big deal, right? Stay invested, keep investing, right? You're not going to need the money anytime soon. If you are trying to retire, let's say this year, and there is a recession, so your net worth or your 401k gets cut in half. Now, can you still retire? Probably not, right? Probably not, especially if you haven't made decisions to put your money in safer investments when a recession does occur, right? So recession can happen at any time. It's unpredictable. We don't know what's going to happen. People have indicators. People predict every day it's going to happen. But if you predict it every day, eventually it's going to happen. So something to keep in mind when people predict a recession. So that's why it's important to figure out, hey, how should I be investing my money to make sure that I don't lose all of it when I do need it, right? Another way to look at it. Great question. What do you think about REITs in the market? For those of you who don't know, REITs, generally speaking, are assets based around real estate, right? So personally, I don't invest in that, but I know that there are pros and cons to investing in it. The real estate market is a little crazy. I don't need to tell anyone the real estate market is a little bit crazy. If you're thinking about buying a home, a real estate market is a little crazy. If you're selling a home, good for you. You're making a lot of money depending on where you are. But I don't understand the real estate market enough to comment on where it's headed, or nor should I, because I can't give financial advice. So you almost got me there, but just something to keep in mind. Definitely something to look into. Right. Personally, I don't have any investments in those. All right, diversification. Basically, when you boil down diversification for purposes of retirement, you are thinking of it sort of like reproducing the results of an age-based fund at a lower cost, because an age-based fund will handle most of the diversification for you based on age, right? But this also means you manage your own risk tolerance, which dictates what to invest in. Now, risk tolerance can come in many flavors, right? Usually, they touch upon many topics, right? Age is one, right? When do you need your money is another one. Or the idea of, can you stomach your investments losing or getting cut in half overnight? What would you do if your investments lost a lot of money? Would you sell it right away? Would you hold on to it? All of these are basically to understand, hey, can you tolerate risk or not? There's also one aspect why there's also one reason, another reason why people get financial advisors, because some people just can't handle risk, right? They can't watch their money get cut in half. And having a financial advisor to sort of curb you toward the right, path is one approach to it. So it's really about understanding yourself, right? Can you manage investments, or can't you, right? So that's something to keep in mind. But if you are curious, you can read more about it on Wikipedia. There's a whole guide about it on Wikipedia. Not Wikipedia, Investopedia, which is an investing version of Wikipedia in a way. But there's a link there. And these slides are going out, so be sure to check that out. All right, so a simple example. Someone mentioned that they would love to volunteer for similar financial wellness focused webinars. Yes, please do. I've been doing this by myself. It's a lot. Always happy to have more folks contributing and giving back, because financial literacy is just so important. Simple example. So young professionals can afford more risk, right? So given this, generally speaking, you can decide your diversification should be 90% stocks and 10% bonds with a focus on US. International is obviously an option. And generally speaking, most people do consider international investments, but we're keeping this simple. So we're going to say just 90% stock and 10% bonds. And I'm not saying that just because you're a young professional, you should follow this diversification strategy. It's more of just strictly an example. You can come up with your own percentages and assets based on your needs, right? And you can do that if you follow, this Investopedia link here. But otherwise, in a simple example, let's say you had $1,000 to invest every month into your 401k. You would invest $900 into FSKAX, which is stocks, and which is one of the investments from that list of 27. And I know it's stocks because I checked out their prospectus. I've checked out their investments objectives and what they actually have invested in the mutual funds. So I know it's mainly stocks. And then I would put $100 in LLDYX, which is bonds, right? And same approach, you check out those multiple areas to figure out if they contain the assets that you need for this specific allocation. Right, so you make sure to maintain this 90-10 ratio, right? Someone asked in the chat, how often should I rebalance? Or how often should I try to attain this ratio, whatever your ratio is? In this case, 90-10. Really depends. Right? It depends on how often you want to visit it, how often you want to tackle this. Looking at your investments, doing the math, and going over it. The more often you rebalance it, obviously, it's better for maintaining your risk. You don't want to leave it for too long. But what that looks like is sort of represented in this chart here. So let's say you have stocks, bonds, initial investments were $900, 90%, $100, 10%, right? 2 months later, let's say your stocks more than doubled in value. You're looking at your stocks being valued at $2,000, and your bonds grew up a little bit, right? It's $120. So now your investments are $2,120. But your ratios are now a little bit messed up. Right now, your stocks are 94% and your bonds are 6%. Just simple math, just simple division here. So now you have to get back to that 90-10% ratio. Or you can decide that, hey, maybe you want to stick to a more riskier approach and you stay with the 94%. But for most of us, you want to stick to your original investment goal, your original diversification target. In this case, you end up with basically 90% in stocks, 10% in bonds. You end up with $1,908 and $212 in bonds, right? So you'll have the same total, more or less, right? If you rebalance, numbers do change over time. You don't have to hit exactly 90-10%, but you want to get close enough, right? And as I mentioned, these are just example numbers. Your numbers are probably going to be much more complicated. Personally, I have a spreadsheet for all of this, so it doesn't get too crazy. But yeah, a lot of great comments in the chat. Financial planner we hired. Love Roth IRAs every year. A person is eligible. Yeah, Roth IRAs are great, right? It's definitely great to invest in those that have many benefits. You're able to put it up until the fiscal year ends at April 15th. True. Yep. Yeah, I love Vanguard. I'm a huge fan of Vanguard. I'm all over Vanguard. I have a Roth IRA in Vanguard. I have a few lucky friends who have a 401k with Vanguard. I don't, but Vanguard's great. But yeah, upon some cash, how do you find FDIC insured investments padding more than almost zero? I'm not sure I understand what padding more than almost zero means. FDIC insured investments. Paying more than almost zero. Okay, I see. Well, generally speaking, I think that for the most part, I invest all of my money that is not going to be FDI insured, right? You do have a different type of insurance. I believe it's SPIC or SIPC, right, when it comes to those investments, but they don't insure you against your loss of money, right? It's a different insurance altogether. But this is where you come across the thing of, hey, more risk means more returns. You can't just have an FDIC insured investment and make a lot of money, right? You got to strike some kind of balance between the two. And there are options where you lock away your money, right? CDs are one, certificate deposits. If you don't have a high yield savings account, definitely get one of those, right? It's still almost zero, but my prediction, right, for what it's worth is that interest rates are going to go up. The Federal Reserve has already said they're going to bring it up. So as interest rates go up, these other safer investments will increase their return as well, just to align with those interest rates and to be more competitive. All right, we are nearing the end here. I would say, a couple things you take away from this is make sure to do your own research, right, and invest in for retirement. If you're not investing in retirement at all right now and you have a 401k with no money in it, please sign on and look at your 401k and try to invest in it, because it's very important to save for retirement. And if you come from an immigrant family, I know you feel this extra hard because your parents have made you probably the retirement plan, right? If you have kids in the future, don't do that to them. Just keep in mind that, if you have the opportunity to invest in retirement, please do. The DIY approach is not for everyone, right? As I mentioned before, as other financial advisors have said in the chat, really try to understand, who you are when it comes to investing. Are you able to keep a level head when your investments lose money? Or can you stick to your investment plan and so on, right? Maybe it's worth it to get a financial advisor, or maybe age-based funds are fine, right? If it's too complicated, you don't want to spend the money, age-based funds are a fine way to go, especially if you don't want to invest time into it. But it's better than just letting your money sit there in a savings account or not in a 401k. Another thing is that your employer may offer financial advisors, right? So something to keep in mind, right? My employer does offer a financial advisor. It's part of the compensation plan, right? If that's the case, reach out to them. They're like free in a way, right? They're part of the compensation plan. So definitely something to look into. If you don't know if they do offer financial advisors, reach out to your benefits coordinator or your HR and just ask, right? Do you have any financial advisor services? And lastly, don't be afraid to call your 401k provider, right? So many people are like, I don't want to talk to my 401k provider. I don't know who they are. I don't want to email them. You should, because they're going to be managing a lot of money for you, probably in the six-figure zone as you save more for retirement. Get to really understand, where your money's going, where the fees are going, and what those different mutual funds are doing. All right, let me just squeeze through this before I answer some of those questions. So I do have free financial literacy coaching sessions, right? These are 30-minute sessions, and I am not a financial advisor. So if you're looking for a financial advisor, this is not what you want to sign up for. But if you just want to chat to figure out what your goal is, right, to figure out how to attain that goal, find information that you need and how I approached it, happy to talk about it. Right? I can't tell you what to invest in, but I can tell you what I invest in, and I try to be as transparent as possible, just so you have a good idea. You can make your own financial decisions, right? And it's always going to be free. I'm never going to charge for these, so you can schedule multiple ones. Some people do. Doesn't matter to me. If you find a time slot, go for it. Otherwise, you can email me and we can figure something out if that works better. Can you call? Yes, I can. Link in the chat. And lucky for you, I do have a Calendly link with everything in it. So as Greg mentioned before, I do have a YouTube channel. that you can check out and subscribe, because you can't wrap this up without saying subscribe when it comes to YouTube channel. Otherwise, this is what the link for scheduling a session looks like. You can also find that here with this link here. Everything should be accessible for the most part, my YouTube, so on. But the goal is to provide as much free financial knowledge as possible, so that everyone can learn, right? Everyone can learn about it, and eventually I can stop doing this because everyone's so educated about it, they can just find their own information, right? Otherwise, my next workshop is on March 22nd at 5:30 p.m., where I'll talk about negotiating your compensation. For transparency, I've negotiated my compensation every year since I started my job, with the exception of the first year. And I do regret that, but always negotiate your compensation and ask for a raise, which is definitely something I'll dive into more detail on the next one. All right, Sam, let's work through some of these questions that we have here.
Alan, I'm going to put a link to register for that next workshop in the chat in just a bit. So everyone, just make sure to hold tight. I'm going to get that link momentarily.
Awesome. Okay. All right. So something about this is where it's encouraged to put your money. The Roth IRA self-adjusts with stocks and bonds with one age. Obviously, they exceed inflation to keep money to have money keep out. Yeah. So just to be clear, right? The Roth IRA is an investment account. It doesn't invest your money for you necessarily, right? So make sure when you put money into Roth IRA, you do actually pick investments. I have some friends who put their money into Roth IRA and they're like, okay, that'll do magic, but it's just sitting there as a cash. So make sure to actually invest it and choose your investments. And you do have more freedom, right? So an IRA gives you a lot of freedom compared to a 401k. The 401k, you have to pick whatever your company negotiated on your behalf for these funds. And sometimes they're bad. Like I have friends who have bad funds, and you're kind of trapped there because there's nothing you can do. Like you want those tax benefits, you want the match, you want the free money, but they're just not returning as much. So that's something to keep in mind. If that's your case, be vocal about it. Talk to your benefits coordinator, HR, to see if they can change it, because sometimes change can happen there, and other people probably feel the same way. All right, I got a refund of $4,000. Can you recommend anyone who can invest it in so it doubles? Come on, I just talked about this. Don't ask questions like that. I can't guarantee you can double your money, right? I think it's important to do your own research in terms of, how to invest and what kind of accounts to put your money into, right? I can see here that you mentioned you're also self-employed, right? So there are 401ks for self-employment, right? You can reach out to the really big investment firms to ask them about it, like Fidelity, Vanguard. They all have self-employed 401k options, so you can take advantage of those benefits, right? And there's a lot of hacks about self-employment where you can maximize your 401k and then also maximize the match, so you could just contribute loads of money into a tax benefit account. But I would say that I can't tell you where you can double your money, right? It's investing, especially for retirement, is a long game. You're not trying to do a get rich quick scheme, right? Maybe you can double your money in decades, right? Or 10 years or something like that, right? If we're talking about not accounting for inflation. But it really depends on what you invest in, right? And that's all about doing your research when it comes down to it. For those of you who are curious about what I invest in for my accounts, I basically invest in total market funds. So for those of you who do know what a total market fund is, good for you. If you don't know what total market fund is, you can Google total market fund. Personally, I invest in a whole bunch of them. For Vanguard, I invest in VT Sachs, right? So that's something that you can take a look into, do some research into. Not saying you should invest in it, right? Because I can't tell you what to invest in, but just telling you what I invest in. Do you recommend contributing to a 401k pre or post-tax? What a great question that I have a YouTube video to that you should check out on my YouTube channel. But just to answer a little lightly here is 401k pre and post-tax, it depends on what your investing goals are, right? So for those of you who don't know, usually companies offer 401k pre-tax, but some companies do offer a Roth 401k which I believe is what they call the post-tax option. And this is the idea that you pay your taxes now and your investments are grow tax-free, right? So when you do withdraw from that 401k, you basically get all the money versus a pre-tax account where you do have to pay taxes later on when you do withdraw, right? So it depends on what your investing goals are, but generally speaking, if you do a pre-tax account, the way that I look at it, if you do a pre-tax account, you do it because you are at a higher tax rate now than you would be when you retire, right? So if you're at a lower tax rate in retirement, you want to get taxed later on. So you do pre-tax. If you plan to be in a higher tax rate when you retire, basically you're going to be withdrawing more money than you make right now from your 401k. Then you can do a post-tax account because you want to pay your taxes up front because you're going to be at a higher tax rate. Now that opens a can of worms because you don't know what your tax rate is going to look like in the future, right? And I don't personally mean your tax rate. I don't personally mean, hey, I'm just gonna spend a lot less money in retirement. I'm gonna downsize. I'm gonna do everything to cut my costs to spend less money. That's not what I'm saying. That's within your control. What's not within your control is tax rates, right? That's within the politicians' control. And sure, you can vote them into place, but you don't really know what those tax rates will look like in the future. They can be high, they can be low, hard to say, right? So personally, my approach is, I put money in a pre-tax 401k and I put money into a Roth IRA just so I have tax benefits from both sides. So if taxes go crazy or if they're great, I don't lose too much either way, right? This is the idea of diversifying your tax risk. Let's see here. Yes, sign up for negotiating your compensation. What else we got here? Rule 72, 7% return, 7% rate of return doubles in 10 years. Yes, Rule 72. If you make the right investments, hopefully you do when it comes to this. But yeah, so much great resources and so much great topics in the chat. Yeah, it's a great group to get information from.
Thank you, Alan. I also had a couple of questions emailed to me ahead of this event, and so I'm going from people who could not attend. So I'm going to read out the question that I was emailed here from one person. They're looking for information on Roth IRAs. I opted out of a 403B because there's no employer match. So I have been putting money into a Roth IRA, and I'd love information on the index funds and how to pick them.
Yeah,
not a very targeted question, but yeah.
Yeah, so that's a lot to unpack there. I would say that even though your 403B doesn't match, there's still going to be tax savings from that, right? It kind of sucks it doesn't match, right? Not ideal. Your only recourse there is to complain to HR or switch to a different company that does match, right? But still, you do get tax benefits. Obviously, if you had to pick between, the two, then it might be a different conversation. But for Roth IRA, in terms of mutual funds, right? So hopefully a lot of this explained most of it for the person asking this question and this set of recording. But I would say, I personally invest in things that try to mimic the S&P 500, right? So any index fund that mimics S&P 500, and there's tons of them out there. So really, it's just quick as Googling index funds. Let's see here, index funds for S&P 500. So it's index funds, S&P 500, and you'll probably get a list of them. Look at all these ads. So, there's a top S&P 500 index funds, right? You can look at these, you can do your research on these and figure out, hey, I mean, this information may or may not be up to date because it's kind of like just written down here. So, but you can definitely say, hey, let's look at this one. I'm curious about this Fidelity 500 index fund. And again, not saying you should invest in it, but this is my approach to figuring out if I want to invest in these accounts. So you see here, here's the area that you can look at to figure out the funds are and how much has grown over time, right? So generally speaking, this follows S&P 500, which historically has been shown to grow over time, right? Just like someone else mentioned in the chat, S&P 500 over any 20-year period in history does around 7% annually, and over a 30-year period, around 10% annually, right? So S&P 500 is shown historically to grow over time, right? So since this fund is matching S&P 500, we can just look at S&P 500 and how much has it grown over time, right? So Yahoo Finance is a good place to look. It's down today, not looking good for this year, but we're not looking about this year. We're talking about really long courses of time, right? So let's say your retirement, let's say it's like 40, 30 years away. So if you look at max, you see, generally speaking, S&P 500 has grown over time, right? So this is not adjusted for inflation, something to keep in mind. But generally speaking, it averages 7 to 10%, right? Closer to 7% if you talk about inflation and depending on how you measure the rate of return, right? So there's a lot of research on this and about this data, but generally speaking, the S&P 500 is a safe investment for many people. And if you can afford to invest over the long term, your money is going to grow, right? So that's one approach to looking at it. We did a mix of domestic indexes and bonds and a small mix of foreign indexes and bonds. Yeah, that's great. Definitely good to have international in there and having those assets in there because, one can argue that the United States will not always be the top performing in the stock market forever, right? So having international in there definitely does diversify your risk when it comes to that. And having bonds.
Alan, another question. The S&P 500 index funds that are environmentally / sustainable friendly, do they bring similar returns as regular index funds over the long run?
Yeah, so that is a tricky one. There's definitely a lot of research, and that research, I believe, generally goes both ways depending on what you're looking at, right? So sustainable and friendly index funds, generally speaking, on a high level, are going to cost more because you have the additional effort that you're expecting of the fund manager to research, right? Research, hey, do these companies meet the criteria that we're looking for when it comes to sustainability? So that's the argument for, it's going to cost more to have one, right? The argument for those funds is that most of the time you can think of these funds as cutting edge, right? If any of these technologies catch on or any of these companies catch on, potentially you could be looking at, a company that will dominate the energy industry, for example, right? Someone figured out solar panels, or wind energy, and they've replaced oil now. So that's obviously a great investment. So, but if you put money into an S&P 500, at a certain point, those companies that do make it and are sustainable will enter the S&P 500 because it's the composite of the 500 largest companies, right? So if they do succeed, they'll end up there as well. But strictly speaking, I personally don't invest in environmentally friendly companies with that investment goal, right? It's probably in some of my investment mutual funds, but it is a little trickier, right? And but you can make money off of it. I'm not saying you can't, but it's just something you need to do more due diligence into, both the fees and what the returns look like compared to the general S&P 500 over time. But it really comes down to what your preferences are, right? And what do you care about when it comes to your investments? Yes, the recording will be sent to everyone along the slides.
Thank you so much, Alan. Are there any other questions from our audience before we wrap up? This has been a really great session, very informative as always, Alan. I know that the majority of my financial literacy knowledge is thanks to you, Alan, these last few years that we've been having these events, so really appreciate it. Anyone have any other questions before we wrap up?
I think someone mentioned about is there a financial advisor I would recommend? They messaged me directly. So I can't say that I'm personally using a financial advisor. I've spoken to a few and I know a few good ones. So if you want to ask me for the contact information, happy to share it. Right. So you can email me with that the link tree there's a little nice email icon. If you click that, it'll shoot me an email with the message that you want, or at least start the email. So you can do that. And also I'm on LinkedIn if you want to connect there as well. But definitely reach out if you want any answer when it comes to that. Obviously, in these workshops, I can't specifically promote a single financial advisor because then it gets a little tricky. But yeah, feel
We
free to reach
encourage you
out.
all to reach out to Alan. He's so generous to offer his time to speak with people, to talk about various topics pertaining to financial literacy. So definitely take advantage of that. Definitely sign up for our next event with Alan as well. We're looking forward to that. Put the link in the chat once again, and we'll include it in our follow-up email. And we will, of course, include the recording as well as the slides in our thank you email later this week. Thank you very much, Alan. I want to thank everybody who joined us this evening. We had a great showing tonight. Lots of people who signed up and attended. So thank you so much for joining us this evening. Hope to see you at another alumni event soon. And Alan, are there any final words you'd like to leave us with?
Yeah, I would say happy investing. Don't stress out about it too much, and just make sure to do due diligence, and you should be fine. And I can't forget to say, make sure to subscribe. I'm trying to get to triple digits here, so anything helps out here. Otherwise, I will see you all the next one. And thank you, Greg and the Alumni Association, for hosting.
I'm
Very
sorry,
nice.
I thought the meeting was at 7:30 and I didn't realize it was at 5:30. So I'm now signing on. Are you gonna include the slides and everything for us?
Yes, we will send out the recording as well as the slides in our follow-up email. So don't worry, even though you might have missed it live, you will get the recording and you'll be able to see everything you missed.
Okay, thank you.
You're welcome. Thank you. Thank you for being here. Thank you, everyone. Look forward to seeing you again soon. Thank you again, Alan, and hope you all have a great rest of your evening. Take care, everyone.